second one I thought was way harder, and you killed that one. So
Yeah, I mean, I know my commodities, I guess. So
yeah,
that's
you know
my
your
thing.
Bitcoin. The Bitcoin
I
was
know my
funny.
Bitcoin.
In
That
like 2
one.
seconds, you're like, yeah, that's
Yeah, 2
Bitcoin.
seconds. Yeah, yeah. That
Oh, that's
lives in
funny.
my nightmares and dreams. So
One,
yeah.
two, three,
Never
four.
going back.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 5th episode of The Exponent with 5i Research. My name is Chris. I'm a senior investment analyst with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today, I'm joined by my co-host, Zach. Welcome, Zach.
Hey, yeah, thanks for having me back on.
Yeah, no, for sure. Always good to have you on here. And so, let's talk a little bit about the markets first. We'll dive into kind of the agenda for today. But so recently we've seen kind of the broader markets pulling back. We've seen a bit of a correction here. US inflation came in hotter than expected. And it sounds like the Fed is not exactly eager to cut rates yet. But on the Canadian side, we're seeing a little bit of a different story where inflation's coming in pretty low. Core inflation's at about 2%, which is target. So that's painting a bit of a different economic picture. The Canadian markets have been correcting alongside the US markets, but largely, we've seen some resilience across the Canadian markets, and the TSX hit an all-time high recently. So that's something definitely to be excited about and looking forward to. So that's a little bit about the background here for the market landscape. Any thoughts on that, Zach? How are you feeling about the markets?
Yeah, I think it's been a bit of a downtrend recently, but some of the things that I've heard kind of going around is that it's like a decent correction in the sense that it's not all bad. Like markets have just been ripping for like 3-4 months before. So it's
Right,
not all
right.
terrible getting a bit of a drop like that.
Yeah, it's a good point. Yeah, it was pretty much up only, especially both Canadian and US markets for several months there. So, for anyone that's sidelined or has some cash or has been waiting for a dip, this is a really good opportunity. That's true. Yeah, it's a really good point.
Yeah.
Yeah, and so we're seeing some stocks go on sale, so that's always good. Let's dive into the agenda for today. So first, we're going to be talking about some interesting Canadian ETF names. Each Zach and I will be going through one each. Next, we're going into some Canadian small cap names. Then we're going to be looking at upcoming earnings that we're watching. Zach will be going through hedging strategies that investors can utilize. And then lastly, we're going to be playing Guess That Chart. So with that said, let's get started into the first section here. So we're going to be looking at Canadian ETFs, some interesting Canadian ETFs. So Zach, do you want to start us off with your first one here?
Yeah, for sure. So the ETF that I wanted to talk about was the Renaissance IPO ETF. I thought this was a pretty interesting one. It's actually a US based ETF, but it's pretty interesting because it provides exposure to just some of the largest and most liquid IPOs in the United States. And when I joined 5i, I thought like IPOs were super interesting, and like looking at new companies coming to market there were so many like good ideas out there. So when I saw this ETF, I thought it was a really cool just idea in their strategy. So it was launched in 2013, and it's actually the only ETF that invests exclusively in initial public offerings. And I think there's other funds that are sort of similar, like there's the ARK Innovation Fund, but ultimately, like this is the only one on the markets right now that strictly has a strategy catered around initial public offering. So I think that's pretty interesting. It's a smaller fund right now just due to sort of the niche strategy and being like relatively new. So it has about 183 million in assets under management, and it's got 59 holdings. The one thing that sort of a bit unattractive about it is it has about 0.6% expense ratio. So a bit higher than some of the other strategies out there, but just due to like how I think there's a bit higher trading involved in it. So that's why, you see that higher expense ratio. But I thought it was a super interesting fund just because, wanting to invest in IPOs is super like interesting out there. And there's a lot of different sort of companies coming to market, but individually doing that is pretty risky. So some of the top holdings that IPO has is like Robinhood, Arm Holdings, Coinbase, and On Holdings. So those are all some pretty cool names, but I think to go into them individually, it would be really high risk. So I think this does a good job of allowing you to get exposure to something that maybe you might be interested in, just the strategy of wanting some exposure to the newer companies coming to market and getting exposure to those like innovative ideas. But individually stock picking in that field can be a little bit difficult. And then another aspect, which I think has changed a little bit, but when I initially found them, I think there was some sentiment going around that, the IPO market could pick up in 2024. I think that's sort of changed a little bit now with like the rates and everything and inflation coming in a little bit, hotter than expected. But I still think, when more companies come to market, this will do better normally because there will be more opportunities for the fund and more big names going to market as well. So I think it's a cool ETF there, and it's a good option if you like, a fun investment.
Definitely. Yeah. No, that's super interesting. I really like what you were kind of saying there about like it's diversifying some of that IPO risk that we normally see. Like one thing that I usually think of when I think of IPOs is for the most part, I see IPOs, take place, they go to the market. They usually move up for the first maybe 3 to 6 months as investors start to get interested and buy into it. But then the valuation starts to appear a little bit lofty. And, usually we see about a 6 to 12 month kind of correction in some of these individual IPOs following their launch. And with a IPO ETF, that kind of takes away some of that individual risk and kind of like layers and staggers out some of those IPO timeframes where we see that correction in the first 6 to 12 months. So this kind of takes away a little bit of that risk and those corrections, and really could provide some good upside, definitely over a long period of time. So that's super interesting. I like that a lot.
Yeah, yeah. And I think the other good thing about it, just to that point, is that they don't just invest in like every single IPO. They target like the mid and large cap offerings. So that's just
Right.
another, you're not getting those high risk, like super small plays. It's companies that you've probably heard of, and there's some sort of built up like excitement about them coming to market.
Right, right. Yeah, that's a really good point. It's not like some small cap that's like under $1 billion market cap. It's usually going to be some big name that's, likely going to have some staying power over the years. On my side, so I've gone with the Evolve Cybersecurity Fund. The ticker is CYBR. And, this is actually the first cybersecurity ETF that came to market in Canada. But now it's not the only one in Canada, but it was the first one. And so kind of the thesis here is, with the rapid rise in cyber crimes and the increasing need for cybersecurity over the coming decade or more, I like this ETF for its exposure to high quality cybersecurity names while still being a Canadian denominated ETF. So there's a growing need for cybersecurity, and also there's expected to be a rapid rise in spending on cybersecurity needs, both by governments and corporations. So some quick details about the funds. So it has 35 holdings, good liquidity with about 175 million in assets under management. About 70% of its holdings are US based. The remaining 30% are international. So its largest holdings include companies like Okta, Booz Allen, CrowdStrike, Fortinet, and some others. And, I like this ETF because it provides Canadian investors with exposure to a nascent but growing field, and it protects different layers of entities. So all the way from the government right down to the individual, with corporations, somewhere in between. It's also well diversified geographically. So I'm going to put some stats up here so we can see, some of its return metrics over, different time frames. And so we can see that on a 1-year basis, it's had a really nice return, about 29%. So some of those names were really depressed, dropped down, and they've come back pretty nicely. Over 3 years, it's roughly flat, and that's kind of in line with the broader markets. 5 years, it's returned about 9.5% on an annualized basis, quite strong. And then since inception, about 13%. So we can see that is a return it's quite strong, above kind of average market returns. Next, I have some other stats pulled up here. So what I've done is I've analyzed the cyber returns against the broader markets for the TSX using the XIC ETF. In the top panel, we can see the cyber ETF in the purple line, and we can see it just going up and above the TSX since inception. Now, what's really interesting in this middle panel, that's its correlation against the TSX, specifically its 1-year correlation. So we can see most recently its correlations dropped to about 0.3. And what that means is, 30% of cyber's price moves can be explained by the TSX. So that's a low percentage. Basically, that means it has a low correlation with the TSX market. And that's a positive thing for investors. So you want, exposure to different assets that, have low correlation with each other. So, for example, the TSX could be rising, but the cyber fund might be declining, or it could be going sideways, or it could be going up. It's kind of uncorrelated completely with the TSX, and that's important to have when the cyber fund, especially in a fund like cyber where it has excess returns. Especially on a historical basis. So that's really interesting, provides some sort of like non-correlated asset for Canadian investors. And in the bottom panel, we just have its total return since inception in 2017. So we can see that cyber does have some larger drawdowns from time to time, but it's also outperformed the TSX on a longer term basis. And, that's a pretty important combo to have, is outperformance on a long-term basis and also non-correlation with a broader market like the TSX. So that's kind of my thinking for the cybersecurity fund for Canadian investors there.
Yeah, that's a great name, and I think it's super interesting because picking individual cybersecurity stocks is pretty confusing. Like, what if you
Right.
try to actually look in to what they do individually? Like, if you look at a CrowdStrike versus a Palo Alto, there may be some overlap, but their businesses can be quite different. So I think that's actually a great option, and it's been an industry that's in demand now and is going to be in demand for a long time. So that's a
Yeah.
really interesting fund.
Yeah, it's a really good point. That's another like interesting aspect of it, is that the cybersecurity field being such a complex and kind of challenging market to navigate at times. This really provides investors with kind of an easy way of gaining exposure to the field without necessarily being an expert in it. So you don't need to know what the best firewall software is. You just need to know that we need firewall software. Next, we're going to be looking at the Canadian small cap names. So Zach, what's your first name here that you have?
Yeah, so my name here is Bird Construction, and their ticker is BDT there. Yeah, so got the price chart right here. So they're small cap Canadian construction stock, and they're trading at about $18 right now, and they're just under $1 million in market cap. So it's done exceptionally well over the last year, up 100%, over 100% actually. And they also pay like a really nice dividend yield as well, above 3%. So there's a lot to like there, and momentum's been super strong. And what they do, it's pretty simple. They're in the construction and maintenance services aspects, and they service key industries such as, in infrastructure, industrials, and the buildings markets. So, pretty like industrial construction type of name, but it's done exceptionally well. And I think a big part of that is due to the fundamental improvements that it's seen. So, yeah, like what makes them pretty attractive is that they're a steady company. they generate high cash flows, and they've got a super strong balance sheet that's been net cash positive for essentially like every time that you go to look over their financials, they've had a net cash balance. So that's a big positive for them. And yeah, they're at 10 times forward earnings right now. So that just makes things even better, to see a company with that kind of dividend, that sort of momentum, and that low of a valuation, I think is pretty rare. And to look at, their fundamentals and how those have improved, they'd been like a pretty steady company the years before, but in 2023 they saw that sort of breaking out in the stock because their, revenues start to do really well. And part of that was due to increased demand from the public and private sector related to more infrastructure spending. And also, an interesting part about the company was that they positioned themselves really well to be the partner of choice in the energy transition. And their investor presentation really pointed out how that's a big focus for them, for wanting to be the leader in that place and being the like first name that sort of companies look for when they want to sort of send out contracts and pick construction companies for these types of services. And they also recently acquired a company called Norcan, which was one of the leading Alberta electrical service providers. And that added, $130 million to their backlog immediately. So they have the M&A activity. And over the last 4 years, I think they've completed 4 acquisitions, all of like decent sizes. So they have some good M&A activity there, which should continue to boost up. And I think their balance sheet really gives them that flexibility to do more in the future. And yeah, so a lot of positives going on right now. The revenues increased a lot, and their backlogs at about 1.1 billion. So there's a lot to like right now with Bird, and I think they could be a good name for some future good growth and that income component as well.
Nice. I like it. Yeah. No, it's an interesting chart too, just looking at it because, it essentially like went sideways for so long and really did nothing. And then all of a sudden, it popped. And like you said, I think it's up, more than 2x over the past year or something. And it's kind of a good case again for like why investors should either pay attention to stocks when they're making new 52-week highs, because it likely means, something's fundamentally changed for the better, or the case for staying invested in high quality names, because you never know when stocks can go on massive runs like they have here. So that's really interesting. And I think we were talking about it earlier, where this is a company that had locked in some kind of contracts at worse pricing previously, and then it's kind of repositioned itself a little bit more favorably, so it can kind of execute well and improve its fundamentals. So that's a super interesting name, and it has a yield, so that's also good.
Yeah, yeah. To your first point there, I think what's also interesting is that they're not like the classic like tech name high growth. Like when you look at that chart, you probably think just over the
Yeah.
last year, like they had some like AI sort of exposure or
Yeah,
something
that's
like
right.
that.
Yeah.
But they're just like a construction services company that just started to, become better fundamentally. So I think like looking out for those opportunities is so important too.
This is you have a chart here with some return metrics as well here.
Yeah, yeah. So these are just the sort of fundamentals of them and how they've been growing revenue and gross profit. So we can see like the nice steady increase in revenue over the last few quarters. And in 2023, that really sort of culminated with a nice uptrend. And the EBIT margins are looking pretty solid as well. Maybe not a huge increase, but they're also ticking up. So yeah.
Yeah. Yeah, definitely. And the consistency in margins is great too. Yeah. Even when they're just kind of sideways, that just shows proper execution by management. So that's awesome.
What's your small cap name?
Yeah, definitely. Yeah. So my small cap name is Docebo. The ticker is DCBO. And so what Docebo does is they provide an easy to use learning platform that enables organizations to train internal and external workforces. So it's hoping to modernize the traditional corporate learning management software market, otherwise known as LMS, by focusing on AI, social learning, and mobile accessibility. Essentially, it's a modern day learning management system for corporations to train their workforces. Um, So it generates revenues through a subscription model. So it's a software as a service or SaaS business. Roughly 3/4 of its sales come from North America, and the remaining 1/4 comes from the rest of the world. And it has various different customers. So some are in industries such as retail, manufacturing, banks, government, education. And so really its customer base is pretty well diversified there. Um, and recently, the company's been working towards achieving its FedRAMP certification. So this will allow it to provide cloud services to the US government. And this is kind of a big deal for the company. That would really increase its pipeline of sales, increase that backlog, and would be a massive sales growth driver. So this is a name that has, historically high sales growth rate within the 20 to 30% range. It's profitable. It generates positive free cash flows. Its valuation is on the high end, just being a high growth tech name. So that's kind of to be expected with that sort of name. But it can always grow into its valuation, meaning, if its earnings are growing faster than its price, its valuation will actually come down over time, even while its price could be increasing at a significant rate. And, it also had a really strong earnings report in late February. So its EPS actually more than doubled estimates. And then after that, it saw several broker upgrades. What's interesting to us, though, is that the price is actually lower than when it released those results in late February. Even though, EPS doubled estimates, we saw broker upgrades. But I think that it's mostly in line with the recent correction that we're seeing in the markets. So I don't think it's, company specific. It's more systemic and relating to the broader markets. And then, looking at its individual metrics in the gray bars there at the top, that's its sales over time. So obviously moving up and to the right, its orange line is gross profit. Those are expanding. And then we see its free cash flow and operating profits. That's the green and yellow lines. Those are, seeing some fluctuation and ebb and flow over time, but largely moving up into the right and kind of expanding. And then lastly, looking at its operating margins, those were negative for a really long time. And recently it's shown some operational execution where it's able to demonstrate some of that operating leverage and expand into the positive territory. So those are kind of the signs that we like to see with especially high growth tech names, just where they're able to turn and flip into a profit. That's kind of like the inflection point where things can really change and the trajectory can get better. And even though it's a high valuation, I think it's a 60 times forward earnings. This is a small tech name that's, about $2 billion, that's growing fast, that's profitable in a niche market. And so in the Canadian space, I think that's kind of a nice area to be in. And so that's why I like Docebo here.
Yeah, it's a great one. I think Canadian tech names, especially, there's not a huge, like compared to the US, there's way fewer.
Right.
So it's great to see like a name like that actually starting to break out now in the
Yeah.
chart here.
Yeah, definitely. But it does have that the buzzword AI, so always have to be careful with that. But I think they have been, kind of leveraging some AI components even before all of the AI hype has kind of started. So that's always important to see.
For sure. And you said
Yeah.
they're in the learning LMS space, I believe.
Right.
Yeah. So
Right.
yeah, I don't think that's too crowded of an area either, right?
Yeah, no, that's right. Yeah, there's one other major player in Canada, and it's Desire to Learn, D2L. So the ticker for that one is DTOL. And Docebo is a larger company than that one, and I believe D2L is not profitable yet. But yeah, there is some competition, but Docebo has so far been proving itself a little bit better in the public markets here. So. Okay, so some two solid small cap names there. Things are looking good in the Canadian markets. There's lots of names to choose from. Momentum's quite positive, and so this is a really good market to be in for a stock pickers type market. So Always love talking about small caps here. So the next segment that we're going to be talking about is upcoming earnings that we're watching. So, it is earnings season. We're going to both be seeing, earnings from both US and Canadian companies. And so on the US side, we've seen some financial names report so far. The banks have been largely reporting some solid numbers, beating expectations. And some insurance names have been reporting there as well. I think we saw Travelers report, but it's down on the day. But the U.S. banks have been reporting some strong numbers, and I think that bodes well going forward for the economy, being that the financials are largely like the backbone of the economy. And I think what's going to be interesting looking into late April, of course, the tech giants being Microsoft, Google, Amazon, those are going to be reporting late April. That will be interesting. But I think some of the less talked about semiconductor names like Intel or, even AMD to an extent will be interesting just to see if they continue to see higher demand for chips, how that bodes for other names, and then largely how that's going to bode for the entire kind of US market, being that it is largely chip, kind of driven right now. We're seeing, NVIDIA kind of holding up the market. So if we continue to see high demand for the chip makers, I think that just kind of helps to carry earnings and the market higher. And then I think another interesting area will be energy names. So those report in late April. And, given the recent rise in oil prices, and just the fact that they're still generating so much free cash flow, issuing strong dividends, I think those are going to be interesting to see how the high oil prices are rippling into their fundamentals here. And then on the Canadian side, earnings are generally later than the US, but late April we're going to be seeing some earnings from companies that I think will be kind of a telltale sign for a few things. One is Celestica, the ticker is CLS. Another is Agnico Eagle Mines, that's AEM. And then TFI International, so ticker is TFII. I think those are going to be interesting. CLS, that can give us some insights into the demand for AI enterprise. Agnico Eagle Mines, that'll tell us like how the gold miners have been doing with the recent rise in gold prices, how that's flowing through to the bottom line. And then TFI International, that'll be interesting to see, if it can ward off some of those industry challenges that we've been seeing. So there's a bit of a freight drought or a recession that people are talking about. So it'll be interesting to see if TFI can kind of fend some of that off and begin to improve its individual industry kind of momentum there. But yeah, so that's kind of what I'm looking at for earnings. Yeah. Any thoughts on that, Zach?
Yeah, I think the semiconductor names was really that'll be interesting to watch, just how good those have done and seeing like if that can continue over the next few quarters and like how much longer is that super high demand going to last for, because they are a cyclical industry, I believe. So
Right.
like I think this is going to be pretty telling for them, and like Nvidia, which is obviously been carrying, like you said. But
That's right. Yeah.
yeah.
Yeah. Carrying the team on its back. That's for sure. Yeah.
Yeah, exactly.
Yeah.
Yeah, but
Yeah.
totally agree with like the gold and oil companies as well. Those are going to be pretty good
Right.
to see, because I think they should be better with like how high the prices and everything have been going.
Yeah. Yeah. No, certainly. Yeah. I think, there's just interesting sectors that I think, aside from technology, that are going to be interesting to look at that, have been kind of on the back burner for a little while. There's been so much talk of the tech names, of AI, that I think, with the larger markets broadening out, and we're seeing some rotation into different sectors, that some of these other areas might start showing some earnings improvements. I think that'll be important here. Zach, next segment that we have here, hedging strategies. Did you want to go over kind of what your thoughts are on some interesting hedging strategies investors can employ?
Yeah, for sure. So I wrote a blog recently on just how investors can hedge their investments and the stock positions that they hold. And I think, if you're sitting there and you have a company's, maybe it's their earnings coming up or just a general risk that you're worried about, you don't necessarily like have to sit on your hands and wait and see what happens. You can protect yourself. And the way that you can do that is through a derivatives and options type of strategy where you're using protective puts and covered calls. So just to like briefly talk about them, like a protective put is, I think, more employable for like a retail investor because it's just a simpler concept. And all you're doing really is you're going long on a put option. So you benefit when the stock price declines because you're locking in a price earlier on. If you're worried about the price declining, you can lock in that price beforehand and just sort of have protection in terms of if it declines, then you're not just sitting on a capital loss. You would have offset that partially or entirely, depending on how much of put options you bought. And the other strategy there is a covered call strategy. So covered calls are a little bit just sort of weird to think about because what you're doing is you're selling call options on your portfolio and you're writing calls. So what's happening, and the way that I like to just sort of intuitively think about it, is that you're selling the right for someone else to buy your stock at a specific price. So that is like a pretty confusing, just sort of array that's going on there. But just in terms of like payoffs, the way that you benefit is that they pay you immediately and upfront for the call option. So you get a profit immediately. And of course, if the price rises above the strike price, you're going to take a loss. But the idea here is that you don't write options on the whole portfolio. You do it so that you have that income component through the covered call and through selling the call option. And then if the price does jump, you'll partially offset that by the remainder of your holdings that would have appreciated in value through the increase in the stock price. So I think both are decent options, but protective puts are just a little bit easier to understand. And just knowing, okay, like I'm going long on a put option, it's a good way to not necessarily like leave yourself out to dry if you're worried about a stock price declining significantly. I think those are two good ways.
Yeah. Yeah, no, definitely. It's interesting. And like you were saying with the protective put kind of being more of the simplistic approach. And it's also, I think, a less like a less risky approach in the sense that, well, if you're, 100% covered on the covered call strategy, your downside is still limited. But with the protective put, when you buy the put, your maximum drawdown with that put is just what you paid for it. So you're not like exposed to any sort of extra downside in the event that the stock, goes extremely high, like pulls like a GameStop basically and just goes infinitely higher. So that's kind of a benefit of just doing a protective put. The covered call, I think, like you were saying, it's a little bit more complex. Investors have to watch for like nuances, making sure that they're fully covered, things like that. And one thing that I've heard that's interesting with covered calls is, covered calls are best used when volatility is high and implied volatility is high. So so investors are kind of gaining as much premium as possible. Next, I think we have a game that we like to play called Guess That Chart. So here Zach's gonna put up a chart, and I'm going to have to guess it. Okay. No, I know that the red line is Bitcoin.
Yep. Nice.
Yeah, I recognize that the initial first, what is it, 6 months or whatever there, where it, flat up tabletop kind of pattern.
Yeah.
Okay, purple is Nvidia.
No, they're
Okay.
they're not stocks, is what I'll say.
Okay, so that's a commodity. Okay, is it like a tech commodity or like a traditional commodity?
Traditional commodity, not a crypto.
Okay, I'm gonna say like copper or lithium.
No.
Okay.
What about the blue line?
Okay, blue line. I feel like blue line is so muted that
Yeah.
I can't really distinguish what it's done. but blue line is also a commodity.
Yeah, they're both commodities.
Okay. Can't be oil because it hasn't been. No. Is it natural gas or one of them's gold?
Yeah, blue line is gold.
Blue line's gold. Okay.
Yeah.
That makes sense. Yeah, 20%. Okay. Yep.
And then purple line.
It's not silver, is it? No,
it's not a metal.
Okay, it's not a metal. Oh, is it cocoa?
Yeah.
Okay.
Nice. Good job. That was a big redemption. This one, I thought this one.
Yeah, that was a big redemption. I'll take that. Yeah.
No, that was awesome. That was I would have had no idea for either one of you showed me that. So that was a great job.
All right, let's go. Yeah.
Yeah, but I just thought this one was pretty crazy. Like that just boom that Coco's had, and outperforming Bitcoin is pretty hard to do, especially
that's
when Bitcoin's
impressive. Yeah. Okay. All in on Coco.
Yeah, apparently.
Let's go. Yeah.
No need for crypto. You can just buy Coco.
No, that's right. Yeah. That is impressive.
Yeah.
Wow.
But
yeah, I knew that cocoa was rising, kind of like how eggs and some other of those commodities were like wheat and other things. But yeah, I did not know that it had such a staggering, like almost parabolic price action there. So that's
totally. Yeah. It's it's kept pretty good pace, like even before it just shoots up. Like it was above Bitcoin, like in line with it for the last year. So
that's all for today. We hope that you enjoyed this episode of our podcast and learned something new about the Canadian markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.